The 60/40 portfolio is a popular investment allocation comprised of 60% stock and 40% bonds, and has long been a benchmark for investors seeking a balance between growth and income for their portfolios. Over the last several years, unfortunately, this allocation has failed to produce the level of income and protection, especially in down equity markets, that it had produced historically.
As a very recent example, in 2022, the S&P 500 was down over 18%, and the U.S. Aggregate Bond Index was down over 13%. So many investors have been asking, is there a better way to invest? At Legacy Capital, we believe there is.
Large pensions and endowments moved away from the traditional 60/40 portfolio decades ago. Most of the large endowments, including Yale and Harvard, have invested a meaningful amount of their assets in private markets and other alternative asset classes. As you can see from this chart, endowments over $500 million have over 40% of their assets in alternative investments, while endowments over $1 billion have over 60% of their assets in alternative strategies.
If many of the largest pensions and endowments have such meaningful allocation to these asset classes, shouldn't you? At Legacy Capital, we believe you should. This brings up the obvious question: why do pension and endowments have such large allocations to private markets and alternative investments, and how are they different from their public market counterparts?
While we are proponents of having public equity and debt in our clients' portfolios, we're also big believers of owning private equity and private debt in most of our client portfolios. By adding private market allocations into a traditional 60/40 portfolio, we can improve the distributable yield, lower the portfolio volatility, and still provide an increase in overall portfolio return.
This chart, prepared by Ares Wealth Solutions, shows an illustration of how replacing half the 60/40 portfolio with private market investments in equity, debt, and real estate improved the outcome for investors. The total return improved between 2 to 3% per year, while the volatility declined by a third compared to the 60/40 portfolio. The yield also improved 60%, from 2.5% to 4%.
If you're interested in learning more about how you could integrate private market and alternative investments into your portfolio, we would love to have a conversation with you. If you would like to learn more about two of the largest asset classes within private markets, private equity and private debt, please click on the video link below. As always, we appreciate you watching this video and hope you found it informative.